On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. That's another week done and dusted, and it's also the first month of 2025 that is now behind us. So let's run through some of the key events we've seen recently in financial markets, then let's turn our attention to what's coming up in the days ahead. Starting with the United States, the S&P 500 index finished the month of January 2.7% higher, so a great start to the year on that basis. However, last week we did see quite a bit of volatility. We obviously had the DeepSeek news, which put a bit of a spanner in the works in terms of AI, and the prospect of tariffs as well is right on top of us. So that dented confidence too. The technology sector had a difficult week last week. It was down 4.6%, and Nvidia, which is the poster child and potentially the biggest loser, if DeepSeek is as good and as advanced and as cheap and efficient as some are suggesting it could be, Nvidia slumped 15.8% last week. Technology was actually the only S&P 500 sector to finish the month of January down. Every other sector in the index was up for the month. European and UK stocks have been much stronger. They were up 1.7% and 2% respectively last week, both finishing at new record highs. European shares finished January up 6.9%. That's the strongest monthly rise since late 2023. The FTSE 100 in the UK not quite as strong, but still up 6.1% last month. Fantastic gain. That's the biggest monthly rise we've seen for the UK market since late 2022. Across the Tasman, the Aussie market had a good week as well. The ASX 200 rallied 1.5%. Market's much more confident now that we'll see a rate cut this month, and the index has posted a 4.6% gain during January, which is its best monthly performance in over a year. Local shares still lagging other markets. The NZX 50 index slipped 0.2% last week, and it was down 0.9% in January, so registering its first monthly decline since September last year. Interest rates little moved. In the US, the 10-year Treasury yield finished the week at 4.57%. Not much change there from a week earlier. And here in New Zealand, the local 5-year swap rate finished the week at 3.66%. That's 8 basis points lower than it was a week earlier. Right, let's run through some of the key events and releases from last week, and the Federal Reserve was the central banking highlight. So after 3 consecutive interest rate cuts during the second half of last year, the Fed chose to leave its policy rate unchanged. That was expected. Markets were expecting a pause because we have seen a very solid economy and slightly more persistent inflation pressures. So the upper bound of the Fed funds rate now sitting at 4.5%. It peaked at 5.5%, and markets expect the Fed to go slower from here. We will see another rate cut, but that probably won't come until June, possibly in May, but I think June looks more likely, and we're now expecting just the 2 rate cuts this calendar year, 0.25% rate cuts. That would see the Fed funds rate in 2025 at 4% flat, which is above the Fed's long-term estimate of 3%. The committee next meets in the middle of March, and while we won't see any change at that time, we will get a new set of economic forecasts, so that will be interesting to just see how the Fed's thinking has changed. So the Fed was on hold, but the ECB in Europe did cut interest rates. The European Central Bank cut its policy rate for the 5th time this cycle, so that took it from 3% to 2.75%. This one peaked at a Euro era high of 4% last year. We've seen more steady progress on inflation in Europe, so the annual inflation rate sitting at 2.4%. We've also seen economic activity slow. We got some new GDP figures out of Europe last week as well. These covered the December 2024 quarter, and they were pretty sluggish. Output fell in both Germany and in France, which are the two biggest economies in Europe. So I think we'll see more cuts from the ECB. That policy rate sitting at 2.75, expected to fall to 2% by the second half of this year. On the data front, US PCE inflation was in focus, and this sort of vindicated that pause from the Fed. The PCE inflation report is the Fed's preferred inflation measure, and while it was in line with market estimates, it has just been creeping up a little bit lately. So that annual headline inflation rate increased to 2.6%. That's the highest we've seen since May last year. So it's still well off the highs, but it has been creeping higher these last few months. Core PCE sitting at 2.8%. So again, well off its highs, but still has been a little bit stubborn of late. Locally, we got some business confidence. This was a key release here in New Zealand, the ANZ Business Outlook Survey. It did fall slightly. Headline confidence fell to a 5-month low of 54.4. Remember, things hit a 10-year high late last year, so they're still above the long-term average in terms of those confidence levels, but they've come off the boil after all of that excitement as we saw those OCR cuts start to come through. The own activity measure, which is typically a more useful leading indicator for where economic growth is headed, that slipped as well, down from December's 10-year high, but it's still at pretty robust levels. So I think the story is still intact. Businesses are more confident than they have been for some time, but it's a difficult environment at the same time, and we're not going to see that economic boost come through immediately. It's probably something that will happen in the second quarter, maybe closer to the middle of this year, but still positivity on the horizon. Inflation indicators up a little bit, actually. The net proportion of firms intending to raise their prices in the coming 3 months, that increased to almost 46%. That's actually the highest since April last year. Cost expectations up as well. They rose to a 9-month high, and ANZ did point out that this could be due to the weaker currency. That will definitely be putting upward pressure on expenses for many firms. So a couple of things to focus on there in the detail. One, like the US, inflation is still there in the background. It's largely under control, but it's something we do need to monitor. And also the currency, fantastic for dairy farmers, fantastic for exporters, that it's right down at 56 US cents, the lowest in a long time. However, that's not all good news. What it does mean is that costs for many businesses and consumers are up, because a lot of those things that we import are higher in price for us to buy because of our weaker international buying power. So just a couple of nuances there we need to keep a close eye on. Good news across the Tasman. Australian inflation fell further and a rate cut is absolutely in sight. So the December quarter CPI, weaker than expected. I think that paves the way for the first RBA rate cut this month, February. The annual headline inflation rate fell to 2.4%. That's the lowest in 4 years, below forecasts for 2.5%. So that next RBA decision, which is due on the 18th of February, that will be a Tuesday, and it will be a day ahead of the Reserve Bank decision here in New Zealand. I think we'll see the first rate cut of this cycle. It'll be 25 basis points, and that will be an important turning point for the Australian market and the Australian economy. I think that's another reason why we saw a good performance from the ASX 200 last week. So that rounds out most of the data that we saw last week. Looking ahead, it will be a very busy week, and I think the main focal point this week will be on President Trump's tariffs and any impact of retaliation that we see from other trading partners. So just overnight, Friday night, the White House has said that Trump will be implementing tariffs on Mexico and Canada. They're still quoting 25%, as well as 10% duty on China. And they're saying that that will all start from 1 February. Now, by the time you listen to this, we'll have more detail, and there could be more to this story. I'm recording this episode at about midday on Saturday, and I'm expecting more news overnight. So by the time you hear this on Sunday or Monday or whenever you get round to listening to it, there will be more news flow on the actual detail around these tariffs. But I think that is something that will weigh on the market in the upcoming week, and investors will be laser focused on what it means, whether there's any more to it than this, how some of these other countries react, and ultimately what it will mean for different sectors and companies. So watch the space. There's definitely more to come. Outside of tariffs, there will be some really important economic releases in the United States, including the jobs report, the latest ISM indices, and the consumer survey from the University of Michigan. So where should we start? We'll start with the ISM because that will be out first. The ISM Manufacturing Index for January out on Monday, and then its services counterpart will follow on Wednesday. So last month, the manufacturing ISM improved. The new orders component hit its highest level since mid-2022, so hopefully we'll see a bit of strength there. The last jobs report was also very strong. We saw 256,000 new jobs created in December. That was the highest since March last year, and the unemployment rate fell slightly. Markets were expecting it to be unchanged at 4.2. It came down to 4.1, so that reflected a strong labour market. For January, markets expecting about 150,000 new jobs to have been created and for the unemployment rate to creep back up to 4.2. So we'll see that, the unemployment report, overnight on Friday. It'll be Saturday when we get it here in NZ. On the central banking front, the key event is expected to be the Bank of England meeting on Thursday, and we're expecting a rate cut there too, just like we saw in Europe last week. So markets are expecting the policy rate to fall by another 0.25%. That would take it to 4.5%, and it will be the third rate cut of the cycle. The Bank of England policy rate reached a 16-year high of 5.25% last year, and from here on, this week's cut, markets expect it to fall further, end up at 4% by the end of this year, which would still, interestingly, be a reasonable premium over the ECB policy rate, which is expected to be about 2% by then, and the OCR here in New Zealand, which is expected to be about 3% by then. So that's on Thursday night, the Bank of England. Locally, the key thing to watch will be the December quarter labour force report, the unemployment report, which is due for release at 10:45 a.m. on Wednesday. The unemployment rate currently sitting at 4.8%. That's very close to the 25-year average of 4.7%. This week, markets and the Reserve Bank expect the unemployment rate to increase from 4.8 to 5.1%. So that would be the highest we've seen since September 2020. I'll also be watching the detail. Things that I keep an eye on are the underemployment rate. That always offers a broader gauge of labour market slack, participation and wage growth. So that's on Wednesday morning. Before that, earlier that day, we will get the results of the latest global dairy trade auction. The last auction was good. It saw prices rise 1.4%. We saw a very strong showing from whole milk powder. It gained 5%. So the GDT index, which was up 19% last year, been pretty steady so far in 2025, and prices are pretty close to 2.5-year highs. And remember, we've got that dairy payout that is expected to crack $10 for the first time ever. So that's on Wednesday morning as well. Also, plenty of companies reporting. The international quarterly reporting season keeps going this week. It's been pretty good so far. We've seen more than a third of the S&P 500 report earnings, and so far, almost 80%, almost 80% of companies are exceeding earnings estimates. The annual earnings growth rate for the December quarter, year-on-year growth rate, is sitting at about 13.2%. That's better than expected, better than where expectations were at before the reporting season, and the strongest since the last quarter of 2021. So we'll have more than 100 S&P 500 companies report this week, including another 2 of the Magnificent 7. You remember you had 4 of the Magnificent 7 report last week. Who was it? Microsoft, Apple, Meta, and Tesla. This week, you've got Alphabet, which is the owner of Google. They report on Tuesday, so it'll be Wednesday NZ time, and then Amazon reporting on Thursday in the US, so that will be Friday New Zealand time. Nvidia, that comes later in the month, and that will be the last one of the Mag 7. But 2 more of the Mag 7 companies this week. Not just about the Magnificent 7, you've got plenty of other interesting, important businesses reporting results this week across the world. Diageo, FMC Corp, Nintendo, PayPal, PepsiCo, Disney's on Wednesday, a couple of the healthcare heavyweights as well, Novo Nordisk on Wednesday, and Eli Lilly on Thursday. So there's plenty to watch, plenty going on, unemployment here in New Zealand, and I think the focus in the US, apart from all of those important corporate releases and the jobs report and the ISM indices, will be to monitor what's happening on the tariff front. So That's the week. That's what's coming up. Enjoy it, everybody, and we'll talk again soon. Thanks very much for listening, as always.
For more insights, visit craigsip.com.